We'll just wait for another couple seconds, just still filtering some folks through. It's been a busy day, and then we'll get things started if that works for everyone on the Buggy side. Just for everyone in attendance, another quick reminder, if you have questions during the webinar, please feel free to use the Q&A chat feature, put up your hand, or you can send an email to myself, ben@buggy.ca. We'll have a bit of a Q&A towards the end as well, so feel free to do that. All right, I'll just give another couple quick seconds. I think we're almost there on just approving everyone in the queue for today's event, and then we'll kick it off. Alrighty. I'll just getting it all clear. Perfect. Alrighty, Nicole, whenever you're ready, I'll let you take it away. And to all those in the audience, Nicole Verkint, renowned Canadian entrepreneur, CEO of Buggy. She can likely introduce herself better than I ever can. I'm just going to talk to you a little bit more today about how the world of groceries evolved and the role that Buggy plays in that evolution. So Nicole, I'll let you take it away.
Thank you so much, Ben. I don't know about renowned, but appreciate the intro. I've also got with us on the call today. So Ben, for all of you who aren't aware or are aware, he is the Director of Business Development and Partnerships. I have Taylor, maybe give a little wave, Taylor. He's our scary Chief Financial Officer. Melissa is an advisor to the company and advising on marketing in particular. And then I've got Akram, our COO, on the call as well today. So please, any questions, send them through. And Ben, can you confirm we are recording this webinar as well? If any attendees choose to ask a question verbally, we are recording this. Or if any of you know of any friends who want to hear it afterwards, we're happy to share it. So we are recording this webinar. And yeah, I'll jump right into it. In terms of my background, I am an entrepreneur. I started and ran a supply chain tech business for about 10 years, sold it to Morningstar, and then joined this company exactly a year ago. The company started in 2014, so it was really Canada's first grocery delivery app and business before Instacart was in Canada. The original model was going into grocery stores with gig workers and delivering them to customers. Since I've joined and other members have joined as well, we've raised a little bit of capital to completely pivot the model. And as you'll see today, from what we've studied in the market globally, there's been a huge shift in consumer demand that we've seen, and we've pivoted the model quite tremendously towards this dark store model, which I'll jump into. So first, just starting with some forward-looking statements, you should see them there. Obviously, we're not providing investment advice, just providing an overview of the company, and no guarantees on investment return, et cetera, but encourage you to take a look and read that directly yourself. So just taking a full zoom out and taking a step back at the retail environment, maybe a few of us on the call are a little bit older than some others, and we'll remember the heydays of the Eaton's department store, but we actually saw that company fail. I think a lot of us forget that it was in the late 90s. And so we started to see the demand for the mega large department stores starting to come down, starting to struggle. Actually, that company in particular started with e-com, which is interesting. They started with their catalog. But if you just look at the overall trend, this is not a new departure. A shift towards more online and smaller stores started about 30 plus years ago. So it's been a constant trend line of which COVID accelerated. Things like Walmart, which is another example of a modern large department store. About 10 years ago, the narrative in the retail market was all about how Walmart is stealing all of the business from the small, Main Street stores, small retailers. And it did do that mainly because of the volume they have in purchasing, the scale in terms of how much they can purchase, and they're renowned for really pushing brands down to the lowest possible margins and getting the prices as low as possible. So despite having that reputation, we've seen a massive shift from Walmart towards Amazon in terms of their total retail revenue. And that is primarily because Amazon was way ahead of them in e-com. They started as e-com. So a lot of, if you look at some of the commentary on Walmart's stock price, they've been applauding the increase in e-com revenue. You know, they bought Jet and a couple other acquisitions. They've had a 12% increase in the past year, but it's just because their starting number was just that small. So just to give you some context, Walmart's around that $75 billion a year in online sales versus Amazon's 400 and almost 70 billion. So quite a lot bigger. And the consumer really, the pitch to them was next day delivery. It was really Prime that made them really take off and explode. And as I'll get to, when you start offering 15 minutes and consumers get used to that, it changes the game again quite significantly. So big shift from the Walmart traditional department store to Amazon. And I actually went to an Amazon conference right before joining Buggy. And the one thing I'll say about Amazon that I think a lot of people miss is that it's empowering a lot of entrepreneurs. So in terms of the percentage of sales that are now done by independent companies, online companies that are selling through Amazon is tremendous. So it's been a great story of lifting entrepreneurs through their platform, which I think a lot of people miss. So what's happened in grocery retail around the world, in pretty much every country that, you know, across Europe and the US in particular, and lots of other countries, you see a huge shift away from what I'll refer to throughout the whole presentation as third-party delivery businesses. So that's the model I described that Buggy started with, which is taking an order from a consumer, hiring a gig worker after you receive the order, and sending that gig worker into the store. So consumers around the world have moved away from that model because of three main reasons. The first reason is for that model to survive, they have to mark up retail prices by somewhere in the 20 to 30% range, usually on the higher side of that. So the prices become untenable, especially with what we've seen with grocery inflation in the last year. So really high prices with that model. The second reason is that the third parties have no idea what's actually in that store in that exact moment. They just have data on what is on that store's website. So you're constantly getting substitutions if you've used those platforms, and I know everyone from our team has, and it's extremely frustrating because you've used it to save yourself time. You're busy working, you're busy looking after your family, whatever you're doing, and the last thing you want is to get a whole bunch of phone calls or to get something that you didn't want. People can be very picky, especially with their food. You know I only drink light coffee. And the one time I used one of the third-party delivery apps, they brought me super dark roast that I couldn't stomach. So substitutions is the second reason. And the last reason is that it is virtually impossible. I know a lot of them will advertise that they're as fast as 1 hour, but if you just think about the logistics to receive your order, have the company go out and find a gig worker, a contractor, to then drive to the store, which is at least 20 minutes away, park in a huge parking lot, and then go around that gigantic store and shop for you. It's truly, at the fastest we've really seen practically is maybe 5 or 6 hours, a scheduled time. Next day is more common. So long waits to receive your order. So across Europe and in the US, and this is what convinced me to come into Buggy, is I saw this new market, this new model really taking off. And that model is one where the company, this is what we are doing at Buggy, which I'll introduce, is they set up these small micro warehouses. So they're about the size of a convenience store, 1,200 to 1,500 square foot. So it's smaller. You're not spending millions of dollars in rent a month on these mega stores. And it's really driven by technology. The technology has a live feed into what's sitting on the shelves in that exact micro warehouse in that exact moment. And it's optimizing and only showing the consumer exactly what's in that store. And then it's using AI and lots of other predictions to only order what they feel is needed for that short period of time. So it's holding that inventory in a micro warehouse, very, very close to where consumers lived in highly dense areas, receiving orders and then sending them out via courier, typically e-bike full-time employee. So they're able to get it to you very, very quickly, as fast as 15 minutes. The other thing we've seen is we've kind of seen the really large grocers say uncle, in the sense that they've admitted that this model is the future. They've admitted that this model is working around the world. And some of my favorite meetings that I've had with Buggy has been meeting with the brands themselves. So meeting with, say, the account manager, and Ben does this as a full-time role, but meeting with the, say, account manager of Ben and Jerry's, where they talk about the explosion they've seen in selling through this dark store model in other markets, in other geographic markets, and they still see Canada as an exception. So I know in Canada, Loblaws announced their partnership with DoorDash to start to open some of these stores. In the US, you've seen large grocers partner with some of these companies, same with the UK. So in summary, you've just seen this massive shift, and it's happened very, very quickly. I'll get into some of the valuations of the traditional rapid delivery companies and how quickly they've gone from zero to multi-billion-dollar valuations. So it's happened quickly. So just to step back to provide an overview, exactly what happens in rapid delivery. So you as the consumer, and I encourage any of you that are on the webinar today, if you are located in Toronto or London, Ontario, please download and use our app and try it for yourself. So you're going to open the app, enter your address based on where you're located. The app will only show you exactly what is in the closest micro warehouse in that exact moment. You put them in your cart or your buggy, press order, the micro warehouse receives the order. It'll go ding right on the screen. I like to kind of see it as a fire hall in the sense that the couriers and packers are waiting there, anticipating orders, especially now as we ramp up and they're receiving 30 plus orders per store per day. So they'll pick and pack an order in under a minute. It's very, very quick. They use technology and the way Acrom's operations team optimizes exactly where all of the items are located. It's optimized for frequency of order as opposed to the way you would traditionally see a grocery store with its categories. So we're optimizing for that. And then the courier gets sent out right away. They're dispatched and they're going straight to the consumer's house. So our e-bike radius would get somebody there in under 15 minutes. We have widened out the catchment area to allow any orders essentially under an hour. So we're optimizing for our long-term profitability. But for our customers that are located close by and they've used our app, they're going to get those orders right away. So definitely the absolute fastest in industry standard. Here's some data, which I won't go over on an individual graph basis, but essentially you've just seen this massive increase in demand for the rapid delivery business. And you've seen it mostly in the last couple of years. You've continued to see this demand and this increase post-COVID. And I will get into that, but every graph that we've explored from a global market is that it's just seen exponential growth. Here's an overview of, for those of you on the call, you're probably exploring potentially investing in Buggy through our retail capital raise. So this will give you an idea of some of the valuations that we've seen in the largest rapid delivery businesses around the world. GoPuff is very well known for anybody living in the US, especially the younger demographic. They are very dominant on college campuses across the US in lots of major cities. So while they got started in 2013, they really didn't see their growth until 2020, and they just exploded in up to over $1 billion in revenue in a very, very short period of time. They've raised over $3 billion in funding, and their last valuation was somewhere between $15 and $40 billion. So they've raised quite a significant amount of funding at quite significantly large valuations. But really, it's that customer growth that has been so exciting about the company and the customer retention. So just explosive growth in a short period of time and customers returning on a weekly basis. So that's GoPuff, great success story. Deliveroo is a UK brand. Getir is another huge success story, started in Turkey, expanded across Europe. I used them in the UK a few times. They ended up acquiring Gorillas, which was originally a UK business. And now they are in the US as well. So these are kind of the two big players I like to point to: GoPuff in the US and Getir in Europe and the US. Getir did raise at, I think it was a $12 billion valuation. They raised a couple $1 billion. So they've got a really good runway to keep this going. And there's been lots of other companies in other geographic markets that have been successful, and they've all proven that it's a model that's really attractive for the consumer, because once you start using it, you start relying on it. It's kind of like your Amazon. Once you start expecting next day, you apply that to everything you do. So I like calling out the elephant in the room up front, and what we all saw happen about exactly a year ago, is about May of last year. We saw a massive decrease in the technology sector in the stock market, primarily driven by interest rates. Inflation drove interest rates up. And then we just saw a reaction in the markets. And with that, we saw a huge change in sentiment from the tech investor landscape, from venture capitalists in particular. And they really like to beat up on this space. So the number of people I've spoken to, and then they reply and send me an article that says something like one of these three headlines. I know, we all know, everyone on the call knows that there's been some bad press around the space. And we don't blame the press for this, because there's a bunch of reasons for this. One is a lot of these companies raised obscene amounts of capital. They raised at extremely high valuations. If it's true that GoPuff raised at a $40 billion valuation on $1 billion in revenue, a 40 times revenue valuation in the grocery delivery business or retail business is pretty insane. So they raised a lot of money during the height of kind of the free money era. So huge valuations. Investors are probably going to see them come off those valuations. But the big thing that happened is, because they had all that extra cash, they were throwing money at customer acquisition. So spending $200, $300, $400, $500 to acquire a customer, to bring them something that was $20, $30, and bring them that basket only once, because consumers in these highly competitive markets were just switching companies. So there's a lot of reasons why this sector has been beaten up. It raised a lot of money, raised at huge valuations. What did they do with all that extra money? They spent it to acquire customers in extremely kind of at high rates. They also entered geographic markets where there was 4 or 5 or 6 of these companies. When I was in London, England last year, there was about 6 rapid delivery businesses all competing and spending tons of money on billboards. So the space got very overheated. It got very competitive. And then at the same time, there was just so much capital with these startups that they were spending it in ways, building up the teams much, much bigger than they needed to. The last thing I'll say is, if you think about it, if you're in this space and you have raised a lot of capital and you're competing against another company, the number one thing you do to differentiate is you just decrease your delivery time. So you were seeing companies commit and promise 10 minutes, for instance. And that changed the unit economics for them very quickly, because you needed to have couriers there. You couldn't batch, you couldn't do some of the stuff that we're doing that makes our unit economics work a lot faster. So just want to completely own and acknowledge some of the narrative around the space, and then talk about why we are so different than what's out there. So if you, again, zoom out and really look at the business, what you can't ignore is that consumers are continuing to come back. So once they start to use the service, like Amazon, they start to rely on it. And we see it in our basket. So we see that a consumer will put in their basket first the couple of things they have just forgotten. And we actually call that basket the I just forgot basket. So we see that. And then we see them come back a week later for a couple more things they forgot. And then within a few weeks, we see the customer behavior start to shift towards increasing to more of the things that you would buy on a regular basis. So your core grocery items, your core essential items, things like your garbage bags and your cleaning supplies, and even finding more unique brands you can't find anywhere else. We're doing a lot of work there, wanting to support craft brands and Canadian owned brands, etc. So we're seeing people start with a small basket and then come back as often as weekly and grow those baskets and increase those baskets as they start to learn what we offer and start to rely on us and trust us. So you can't ignore that the customer growth is there, the customer demand is there. We're not even spending money on marketing because we haven't raised a significant round of capital. So we haven't even started to pour on any fuel to really grow from the marketing perspective. So consumers are coming to this model. They're also adopting e-com in an increasing way. And so the reason I love this chart, this is my favorite chart in the whole webinar today. And the reason I love it is because another narrative I get from the investment community or from various people is they think that this online delivery business was just a COVID phenomenon, or they even tie that maybe the rapid delivery business was just a COVID phenomenon. but they've actually been crunching the numbers. They've come out with this data. The US Census came out with this data. And the punchline is that we were on a trend line that was very clear. It was very clearly going up and to the right. And it was a smooth trend line towards adoption to more online retail, more e-com. And to consumers, you're seeing a few things happen. You're seeing younger consumers entering the market, having disposable income, starting to spend. You're seeing people get used to habits being created, more services being offered online, lots of reasons for this. But we have been seeing a very clear and very gradual trend line towards more of the percentage of total retail revenue shifting to online, to e-com. And that blipped up during COVID naturally. And we saw that happen, lots of activities with businesses in this area, stock prices going up dramatically. We saw Shopify powering a lot of e-com stores. And then it did come down a little bit after COVID. But what we're seeing now is we're seeing it return right back to that trend line that it was already on and continuing to go up. So we see this, we see that it's only a matter of time that we're going to continue to see this habit forming behavior shift to these models and shift away from the third party models. I won't name names, although I would love to, but shift away from the third party models because of those three reasons we talked about: so the high prices, substitutions, and the long wait times. So overall, what does this tell us? The first thing is, no, COVID was not just like a temporary blip. Secondly, yes, that growth was pulled forward, but now we're back to that regular trend line that we had before. Rapid delivery is absolutely here to stay. We've seen the demand for it from consumers. We've seen that retention that we're able to get, frankly, without even trying. Like I said, we're not spending money on marketing. We're not even chasing consumers that we attract. We're not even begging them to come back, which we should be doing, and we will be doing once we raise some more capital. And you're even seeing the large retailers. I met with some senior folks from Amazon when I started in the Buggy role, and they immediately came out and said, no, the model is in the huge warehouses. It's in automating the huge warehouses. And they have to say that because they've committed so much capital to build huge mega warehouses. But now they're even admitting, this article came out about a month ago, from the Wall Street Journal, saying that, well, actually, we need something for same day. We need something in the ultra fast. We've got to break it down into smaller warehouses as well. So I think even the companies that were naysayers that consumers would want and continue to want this faster service are starting to admit that it is absolutely the future. So who are we? It took me a while to get here. That's okay. We're the only dedicated rapid delivery app in Canada. So we're the only company really focusing on it here. We do deliver as fast as 15 minutes. We don't substitute. We are much cheaper than third-party apps. And I will get to this, but we have taken a slight spin on the model. So from your traditional GoPuff Getir model, we've also been open and said, we're going to partner with other companies. So we are set up as stores on Uber Eats, Skip the Dishes, DoorDash, and we're onboarding more of these marketplaces. So we're not so stringent in saying you have to order from our app. So for those of you on the call today, feel free to order from the Buggy store on any of these other channels. We're also doing some really significant partnerships with a few grocers, which we'll hopefully be able to announce very soon, essentially doing white labeled delivery for them, which enables us to get to profitability much faster than the traditional rapid delivery model. And anything negative you read in the media about this model is that it takes a while to get to profitability. Well, we're short-circuiting that and getting there faster through these partnerships and being willing to put multiple revenue streams through one store. So maximizing the overheads, contributions to those overheads. Another revenue source that's very important to us, which Ben leads, is working with the brands themselves. So working with the brands to promote themselves in our app, in our technology. We've got some exclusives with some great brands that we're very proud of. So in some categories, for instance, mosquito spray, you have to buy Raid. We've got an exclusive with that company. Raid is a top brand in the market. And we're able to generate some good revenue by working with the brands and allowing them to promote themselves on our app. Lastly, we're also going to be building out something that we're referring to as retail as a service to enable those D2C brands. So I talked about Shopify and their dramatic increase during heights of COVID and all of these e-com entrepreneurs. I'm sure a lot of you know people that are selling their own products online. So we are also opening up an ability for us to fulfill those products for them. Right now, we're only in Toronto and London, Ontario, but as we build across Canada, we can serve as a rapid delivery option for e-com brands. And then, yeah, I talked about the retention. Our retention number is about 50% month over month, but they get up in the 80% range after consumers come to us for a few months. So very exciting reoccurring revenue that you normally only see with software as a service type businesses. So that's really what gets exciting to investors, is once they start to track that over the long term. Here's just a quick sneak preview into what the app looks like, but encourage you all to download the app and use it for yourself. And then once again, I just have to repeat myself to keep getting the message in, but why do consumers keep coming back to us? We are a lot cheaper than the third-party delivery apps. Those are real numbers that we use by going through another platform versus us. We have live inventory, so we're never substituting. If you need Cafe Verona, we're not giving you Tim Hortons. And we're just a lot faster. So we're picking that order in a minute and we're getting out the door right away. Even if you order through Uber Eats, our average Uber Eats delivery time is in that 30-minute range. So it's still very fast. You're not waiting 6 hours or next day. So just taking a look at our overall business model and those long-term things that are going to drive the valuation. Very experienced team members. Some of them have been around since 2015, 2014. We've worked with these brands for quite a long time, and we're switching that into this new model that we know works around the world. But what we're doing that's a little bit different is we're working with various partners to push them through the same store. So one of the mistakes that a lot of the rapid delivery businesses make is they're paying huge amounts for rent. We're paying much, much less. So one rapid delivery store that we know of paid $12,000, $15,000 a month for rent. We're paying $3,000 a month rent, to give you an idea, on average. So we have a much lower rent. And then within that rent per store, we're pushing more business through it by partnering with Uber, Skip the Dishes, DoorDash, by doing this white labeled rapid delivery, and then also by working with the brands to be able to have them pay to promote their brands, etc. The other thing we've had that's pretty interesting is when you start to search for certain products in Canada, we really do have top SEO results. And I think that's because we've been around for just so long in Canada before Instacart. So we get a lot of inbound that way. And that's a real asset for us from a data perspective. It's sending a lot of people to us. So for a fifth or sixth or seventh final time, we're just a lot cheaper, don't substitute, and we're a lot faster. So really differentiated from what else is out there. Because whenever I talk to people about what we're doing, they say, well, doesn't Loblaws or Sobeys or all of the different grocers have their own delivery service? Well, those are the three reasons why we're a way better offering for the consumer. So reasons to invest would be our value proposition to consumers. We are growing through partnerships and by working with the brands. And we are building out a tech platform when it comes to providing brands insights. We're going to be working on that. That's one of the use of funds from a capital raise. And then, lastly, we are really focused on unit economics and a path to profitability. We're really serious about that. We got started on this pivot right as the tech market kind of came down. So from day one on this new mission, we've been very, very focused on path to profitability. And we believe valuations are going to return in the market for this business. They're definitely, I don't think they're going to go as crazy as they were, but they're definitely going to return. And our valuation, we've got $5 million in revenue or GMV, and we're raising this round on Front Funder at a $20 million valuation. So nothing like the kind of valuations we were seeing with the GoPuffs of the world. So our growth plan, I see some Q&A coming in, but I'm just going to wrap up a few more slides. So our growth plan, we're going to be completing a technical integration with one of the large grocers, hope to announce that soon, work on the Fulfilled by Buggy technology. We are going to complete a capital raise here, later on this year. We hope that Front Funder is just the start of that capital raise. Then we're going to start to open up more stores across Canada. We're going to focus on highly dense urban locations and university locations. Here's a map of where we're thinking of opening up. So we've got our stores in Toronto. So we service everywhere south of Bloor in Toronto. We've got London opened. And then we're going to expand Kingston and Toronto Midtown are kind of next on our wish list. And then we're going to continue going from there. So every major city. We also acquired the assets of Ninja and Tiggy. So some of you on the call might know those companies. We did acquire their assets. I've got a slide to that effect way at the back. And one of those things we acquired was their customers. So we will be able to, when we go to some of these other markets like Vancouver and Waterloo, tap into those customer base, which is really exciting. Use of funds for the capital raise, marketing, we have not been spending much on marketing at all. So really driving that customer growth. Once we get that really rolling, then we'll start to open up more micro warehouses. We feel we have a very strong playbook for how to open up micro warehouses for a very, very cheap cost. So in some materials, we saw Akram when we were looking in the early days, the cost to expand micro warehouse was in the $350K range, and we've got it down very slick in the $60,000 range. And that's just for upfront inventory, some shelving and fridges. So, we're able to open micro warehouses and be very capital efficient. Continue to build the team. We've got a solid team right now. I'm really, really happy with the team. And hopefully you get to know a few more of the team members through the Q&A. And then we've got some technology to build. So we've got some integration work, the grocers, build out the data insights platform, and improve our app. Here's the link back to the front funder. We're happy to follow up from the webinar with that link. But also, if you're not ready, the investinbuggy.ca website enables you to get onto our email list, and we will be providing more information over the next, I know it's a 90-day campaign. It's been going for only a couple of weeks. So we do have some more time for people to learn more in the interim. So I'll leave it there. I know we've had some questions come in. Ben, I'll turn to you then maybe to field those questions.
Absolutely. So we have a few questions that have come in live, Nicole. We've also had some questions that were submitted beforehand. So what I'll do is I'll go through, read some of those questions. If there's a team member you think is particularly adept and able to answer that question, feel free to field it to them. So we have a question that has come in here. It's a question about some of our orders through third-party platforms. This question in particular is about DoorDash. So the question is it a DoorDash driver that's doing the delivery and picking the items at a Buggy dark store? Do we have any challenges relating to dark store bans or rules like that occur in certain cities? And then there's also another question sort of as part of that I'll ask after, but we'll start with a question about how we manage some of those third-party relationships.
Okay, great. Yeah, I see it. It's actually 3 questions. So I'll start with the first one. It's the easiest. A DoorDash order, a Buggy employee picks the order. So a Buggy employee can pick up to 40 orders an hour, according to our research and some of our early tests. So we're picking the order, and then DoorDash, there's a driver or a rider from their side is coming. It's the same with Uber and Skip the Dishes. So yeah, that answers that question. It's actually very capital efficient for us to leverage those fleets for a bunch of reasons, especially in our surge hours. But I'll just leave it with that to answer that question. Issues with dark store bans. We haven't seen anything to that effect, although as we start to build out our new stores, we're going to be very, very careful to make sure that they are zoned for this type of warehousing. That was the problem in Paris, is that the stores were always zoned for retail walk-in. We also allow shoppers to come into our stores. So in our Toronto West store, we've actually had people show up and order. They just order from the app and then they pick it up. So we can also open up a retail shopper walk-in presence to ensure that we also offer that more traditional retail option as well. And then Good Food. I can't speak to their reasons, but overall, the reasons the other companies have not survived is because they have had high overheads on a per store level. So that's where I was giving that $12,000 versus $3,000 comparison. They have been fully committed to orders only through their app or their technology, and only their couriers. And when you start being committed to only that, you need much higher volume thresholds in order to start making money. So it just makes it a lot harder. They've also spent a ton of money acquiring customers. we're acquiring customers for free through our third-party partnerships. And when we're not acquiring them for free, we are getting quite creative from a marketing perspective to keep those costs down. So it is a capital intensive business, I will say. Everyone that's tried it in Canada seems to have dedicated the same amount, like $3 to $4 million to try to do this. So that's good food. I don't know how much they've committed, but that good is around that amount. Ninja and Tiggy were all around that amount. And frankly, you need more capital than that to really expand it and to get past, the 5-store threshold. So it does take capital, but we are focusing on a very capital efficient way to do it.
And another question has come in of a similar vein to that, so I think it's good to ask now. And so the question is like, why do we sell on platforms like Uber Eats, given that a lot of those platforms take such a big sort of percentage or commission of the orders?
So, Melissa, would you or Ben want to answer that question? I'd love to give you guys a little bit of time talking to the folks in the webinar.
Yeah, absolutely. I'm happy to take that one. So we look at, Uber Eats, DoorDash, Skip the Dishes, these third-party platforms as really strategic partners. And, as Nicole mentioned earlier, as a way for us to really expand our catchment and protect our bottom line. Really what we've recognized is that they've become their own search engine when it comes to the food industry. So when people go, they're hungry or they're out of a food item, if they don't go to Google immediately, where they do go is likely to Uber Eats, DoorDash, or Skip the Dish. So, we recognize that to be as a very, very powerful marketing platform for us. And as Nicole said, in the early days, without the capital to invest in a lot of more traditional or large scale marketing tactics, this is a really smart way for us to be able to reach a very, very broad and motivated customer base. So that's the way we view that, is the commission structure is an investment in marketing for us. It's an investment in customer acquisition and an introduction to our brand. And, one that comes with very strong data benefits. So, we're able to analyze in real time each one of those baskets, which is invaluable to us, in addition to the operations of each individual transaction. So, that's why we know that there is, a lot of conversation around the commission structure on these third-party sites. But for us, it truly is a very strategic partnership and investment in marketing.
Good answer. Any more questions, Ben?
Yeah, there was another one a little bit more financial of nature this time. And it was just about how much sort of Buggy plans on raising, and do we plan on raising going forward? And obviously the sort of common investor question of, am I going to be diluted, or how much am I going to be diluted by if you raise more money?
Taylor, do you want to cover that?
Yeah, I can speak to that. Thanks, Ben, for the question. The answer to these types of questions are almost invariably some variation on it depends. So, the more that we can raise, the more we can do with that money. And so that's something that we've kept in mind as we've been thinking about what the go forward looks like for us, is thinking about a few different situations and where we would spend money differently depending on the amount that comes in. As far as what our current baseline plan is, we're targeting about a $2 million investment. And given where the business is right now and what our short-term plans are, that's something that we would think would get us to where we want to go over the next year or two. Obviously, if we are able to raise more than that through various channels, we can do things like opening more dark stores, opening them faster, ramping up the marketing spend. And it's going to depend on the success of executing that model. So, but as the plan stands right now, as I said, looking at about a $2 million investment and hoping that we won't need further dilution down the road in order to keep that going. But that's going to depend on execution. Anything you want to add to that, Nicole, or is that good?
Oh, no, well said.
So it got looks like a couple more questions there, but if anyone has any more in the audience, please feel free to let us know. This one is a little bit more operational of a question. So Nicole, I think Akram might be the best person to answer this one. But it's just a question about how we sort of manage our inventory and make sure that we keep our best-selling items in stock.
Yeah, absolutely. Thanks, Ben, for that question. I'll be happy to answer that. So we rely a lot on our technology. We have inventory forecasting models that analyzes past purchasing behaviors, orders that we've been selling to see really products that are doing well, products that maybe aren't doing so well, to make informed decisions of what to order, and then our procurement department takes that data, takes those reports to make decisions on what to reorder. In addition to that as well, we've committed as a company to always keep a list of top selling items in stock at all times. And so we've got steps in place where at an individual store level, on a day-by-day basis, if for some reason our forecasted demand is, if our actual demand is greater than our forecasted demand, and we end up getting close to selling out of certain items, we make sure that we get those items as soon as possible, so that we have them, because we understand that customers come onto our website, onto our app, and sometimes they really want those items, that they're in a pinch. So we want to make sure that we are there for the customers and we can fulfill those orders.
And so one more question I see here is just somebody was curious to learn a little bit more about what exactly retail as a service is, and a little bit more about how we partner with some of our brands. So I might shed a little bit of light on that if that works for everyone. So retail as a service, truly, I think it's one of the most exciting parts of Buggy. It's also because I work on it. But I think there's a lot of potential there for us to generate a lot of operating leverage, because essentially what retail as a service allows us to do is it allows us to sell by more channels and sell more goods while having sort of, us the same amount of fixed costs. So there's a number of different retail as a service models we've seen. We've seen some where we help large brands sell through a channel like Amazon and actually offer them almost like a third-party fulfillment type service. We've seen success enabling other brands doing their own direct-to-consumer sales through a third-party marketplace. We've seen success as well helping brands even offer rapid logistics to their own customers, taking advantage of some of Buggy's logistics networks there. So we've seen a lot of success and uptake through these brand partnerships, taking advantage of expenses that we already have to incur anyway. And it's been a really great way to generate additional revenue for the organization. I don't see any other questions remaining at the moment. So if anybody else has any additional questions, comments, or concerns, please feel free to send myself a quick note, ben@buggy.ca. Happy to book some time to chat more, answer your questions by email. To everyone in attendance, we will be sending out a recording of the webinar shortly, so feel free to watch again, feel free to share with your friends, all that fun stuff. And feel free to visit our page on FrontFunder if you'd like to learn more or are interested in investing in Buggy. Just give everyone another quick minute in case there are any last-minute questions. But otherwise, folks, you're also free to carry on with your day. And on behalf of all the team, we'd like to thank you very much for joining us.